So it's not that there is no danger, rather. I would estimate that these centralized corporations already have several 100,000 coins. Although there is more than that when factors like Coinbase are considered, they are still in the minority. Just a small fraction of all coins are held in these massive centralized honeypots. This might lead to a small rise, but it won't be enough to change things drastically. For example, if you weren't concerned about large institutions holding 15% of the coins, then 20% probably won't make a difference. I correct? Or 600,000 coins in exchange-traded funds, ETFs, that aim to reach 1 million or 1 billion plus 2. Correct? It's not that that makes a difference. Spot Bitcoin ETFs and the impact of large Wall Street firms like BlackRock, who own hundreds of thousands of Bitcoin, continue to divide Bitcoin investors. Even though many have been talking about BlackRock's unexpected interest in Bitcoin for the past year, fears about the hazards have increased with the approval of ETFs and the boom in Bitcoin purchases. According to information seen on BlackRock's website, the Issuer's Bitcoin Trust doubled its ownership from 66,800 Bitcoin on January 31 to 141,142 Bitcoin as of February 27th. Bitcoin ETF, the biggest asset manager spot in the world, is still crushing the competition across the board. Previously set on February 13, Tuesday's record daily trading volume of $1.36 billion and largest daily inflow of $52.2 million were both achieved by the eShares Bitcoin Trust. On the other hand, a net inflow of $19.8 million was recorded by all spot Bitcoin ETFs on Monday. Bitwise's BITB received $18 million, putting it in second place after Fidelity's FBTC, which received $126 million. Does a large portion of the coins going into Bitcoin ETFs pose any kind of risk, or is it just a matter of how many coins end up in these funds? 10 years ago, when the Winklevoss twins first suggested a Bitcoin ETF, which was a positive development, I believe that would have been a bigger deal. That is to say, it was reasonable for them to act that way. In the beginning, they were this entire asset thing. If that had occurred, though, it's easy to see how many Bitcoins would have ended up in exchange-traded funds. It was fortunate that Bitcoin now had 15 years to disperse. As a result, returning a large number of coins to a centralized custody system is a daunting task. Using GBT, see, there were already over 600,000 coins in a trust, which is essentially an ETF for the purposes of this discussion, rather than an ETF itself. Up to 1,700,000, 800,000, or even 1 million coins still only represent 5% of the total. Consequently, the more you acquire, the more that is probably going to affect the price. Because of such, increasing one's portion of the network becomes more challenging. You receive a higher monetary value, but the value of the network is growing. So I think there's a limit to how much of the network you can continue to put into ETFs. I predict a spike in both the absolute value and the percentage of Bitcoin in circulation in the near future, due to the pent-up demand from managed walled garden capital firms that are interested in getting their hands on some of the cryptocurrency. So I think with that needs meet, it starts to kind of slow down. The major threat, because it's a proof of work network rather than a proof of make network. It's not so much about transaction censorship and things like that. The primary part would be kind of selecting what side wins in like a hard fork, or significant owners have a kind of an influence on that sort of thing. There's an economic push that happens. If you weren't worried about 15% of coins being held in big institutions, 20% is not going to be the game changer, most likely. Right. or 600,000 coins in ETFs specifically, going up to a million or billion point two. Right. That's not what changes things. So overall, I think that risk is somewhat overblown. And I also think that some of the no coin or TradFi arguments are Bitcoin is no longer like cypherpunk money because it thefts on it. Right. But that's a silly argument because Bitcoin didn't decide to have ETFs on it. It's not like the Bitcoin Committee Council got together and decided we're going to have ETFs now. There's no such thing as a Bitcoin Committee or Bitcoin Council. Bitcoin is just an open source protocol. And now TradFi has decided to put structures on top of part of it to bring some of it into its own system. All the ETF is in developer terms, basically an PI for the fiat system. It just allows the fiat system to plug into Bitcoin a little bit better than it used to. That's all that these do. It's an upgrade to the TradFi system, not an upgrade to Bitcoin, even though it moves Bitcoin price more than it moves TradFi price this cycle. And so that doesn't change the fact that there's other uses of Bitcoin that are more cypherpunk, right? If our parents have Bitcoin in an ETF, right, that's not particularly cypherpunk, but they don't really have a cypherpunk need right now. So they're like fine with that. Whereas I think that, kind of the ongoing battleground will probably be around privacy. So Bitcoin is kind of won the war for like existence. And I actually think it's starting to turn the tide about the whole energy debate. There's a lot of really good pushback on the whole Bitcoin is going to consume all the world energy and blow our oceans narrative. And there's a lot of pushback on that, both in terms of narrative and in terms of grid balancing or the understanding that it mostly uses stranded energy and it's incentivized to use the cheapest edge in the world, which is mostly energy not being used. Right. That is slowly getting into the media, into academia. But I think the battle that's still far big one is privacy. I think it's oversold in the near term. Like, there's no strong correlation between the halving and, say, 3-month price action. Sometimes the bull market's already underway before the halving start. Sometimes the bull market happens after the halving. It's a fairly small percentage of volume overall, and changes in demand can matter a lot more. Where I think the halving really matters is actually over the longer term. Obviously, if Bitcoin did not get more disinflation over time, the price would be much lower. If there were still 50 coins coming out per block, that would be huge. You'd have to have a much lower price in order to absorb the amount of issuance coming. And so it's certainly relevant. And I think the main thing is actually the higher lows in each bear market. The halving is really important for that because at a time when there's no new marginal demand for Bitcoin, there's some buyers getting out of Bitcoin. The fact that hodlers can basically absorb the supply as the price gets cheaper, they can buy more coins. And now there's fewer coins coming to market than there were in the prior cycles. That's really relevant for having a higher price floor in bear markets. And so I think overall,